When you need to build up your team to handle the growing chaos at work, use Indeed Sponsored Jobs. It gives your job post the boost it needs to be seen and helps reach people with the right skills, certifications, and more. Spend less time searching and more time actually interviewing candidates who check all your boxes. Listeners of this show will get a $75 sponsored job credit at Indeed.com/podcast. That's Indeed.com/podcast. Terms and conditions apply. Need a hiring hero? This is a job for Indeed Sponsored Jobs.
This episode is brought to you by San Pellegrino Ciao. A gift from Italy to your home. San Pellegrino Ciao is a flavored sparkling water made with real fruit juice, finished with a pinch of Sicilian salt for a perfectly balanced taste. So which flavor will you choose? Peach, lime, blood orange, cherry, or maybe the all-new limoncello? Crafted in Italy with 0 grams of added sugar. San Pellegrino Ciao. Buy it now.
You're listening to a Markets Radar on the Age of Jeremy. My name is Jeremy Quintanilla. Thank you so much for tuning in. This is a show all about markets, stocks, bonds, crypto, international, and everything in between. And I give you my take on what it might all mean. Before we get started, make sure that you follow me on Instagram at Age of Jeremy. Make sure to join my Dope Insights and broadcast channel where I provide additional information and additional insights into what's going on in the Age of Jeremy verse. And I want to just give you a heads up that this show will be moving to its own feed eventually, but don't worry, we'll make sure that you have easy access to get to it and so that you can find it wherever you listen to your podcast. And thank you so much for tuning in and listening. We are going to unpack a major shift happening right now in the markets. We're seeing a significant sell-off in chipmakers, which has dragged down the overall stock market today. And again, I'm recording this on June 7th, 2026. So by the time that you hear it, the news may have changed. This pullback is driven by growing concerns over whether the massive investments flowing into artificial intelligence can truly justify the lofty valuations we've seen since the market rebounded from war-driven lows. To put this into perspective, semiconductor stocks just wrapped up their best ever quarter, which was an extraordinary surge fueled by what seemed like an insatiable demand for artificial intelligence. But the mood has suddenly shifted. Wall Street's best performing corner this year took a beating, with a major gauge of semiconductor firms sinking 4.5%. The NASDAQ 100 also fell 1.5%. And remarkably, even Samsung Electronics, one of my favorite companies that's based in Seoul, South Korea, recorded a record profit. What recorded a record profit wasn't enough to entice investors to step in. With chip stocks tumbling, are investors panicking that the AI rally is completely over? Well, if you guys don't know, today there is also a launch of Meta AI's Muse Spark inside of their Meta AI app. I haven't had a chance to play with it, but that did come out today, and that's the first, I guess, language model or new type of product that Meta has released since spending billions of dollars rebuilding their AI research department. So again, thinking of it from that capacity, I don't think AI is completely over. I think it's starting to level off, and we will start to see a consolidation like we see whenever there is any type of bubble. But is it really overdone? It's less of a panic and more of a reality check. This is according to Ulrich Hoffman-Burkardi of the UBS Chief Investment Office. There is still strong confidence in the underlying AI growth strategy, and they continue to see attractive opportunities in both semiconductors and hardware. However, the next lag of equity gains will likely require a broadening of market leadership, meaning investors need to ensure they have diversified exposure. We are also seeing companies actively trying to manage the immense cost of this AI boom. For example, Microsoft is starting to replace models from OpenAI and Anthropic with its own proprietary models and software products like Excel and Outlook, specifically to reduce artificial intelligence costs. And one of the biggest problems with artificial intelligence that people haven't really realized is the cost of utilizing the infrastructure of artificial intelligence. So at the beginning, Microsoft was using OpenAI, they were using Anthropic, but essentially the partnership and the purchasing had to do based off the amount of tokens that you spend. The cost of that is outweighing possibly even having people do the work for you and or spending the time researching and developing your own models, which is actually what I would like to see inside of the industry, because essentially the models themselves are only essentially built around ChatGPT, OpenAI, ChatGPT, which is OpenAI, Anthropic, which is Claude. You also have SpaceX, which is now XAI, which has XAI, and then you also have Google's DeepMind. And so essentially, the entire artificial intelligence community is segmented into those essential four techocracies that can essentially manipulate the entire marketplace if they really wanted to. And to see Microsoft moving away from that and building their own language models to reduce costs, but I also think it kind of diversifies it, and we need to see more of that diversification in the AI models themselves. From an investor standpoint, I would recommend that you work to divest some of your money out of the Mag 7 and out of other tech stocks. There are other opportunities inside of the markets themselves, but I think a lot of the news, including this show and a lot of shows that are similar to Markets Radar, we tend to focus on those tech stocks and some of those bigger stocks. But if you deep dive, one of my favorite products that I own, it's an additional purchase that I have for Barron, it's Investors Circle. I can go on and look at all the technical analysis that they have in Barron's Investor Circle and get all kinds of ideas for all kinds of stocks that are in the marketplace that are about to move. And you can take positions in those as well if you believe that they can be an overall part of your portfolio. And again, the need for diversified exposure brings us to the biggest theme of what I want to talk about today is market rotation. Despite the volatility in the tech sector, most companies in the broader S&P 500 actually rose. This is a massive signal that money just isn't fleeing the market of AI, it's rotating into other sectors. Mike Wilson at Morgan Stanley pointed out that momentum in chipmakers is fading and investors are shifting their capital back into the year's laggards, which include hyperscalers. He noted that the recent divergence in the market simply isn't sustainable. Matt Millay and Miller Tebeck agree that the sector rotation is a popular topic, but he emphasizes that the rotation within the tech sector itself is the most important trend to monitor right now. The overall equity rally has flattened out over the last 4 to 6 weeks, but Malley views this as merely a breather after the market's exceptionally strong run in April and May. If this internal tech rotation can continue, the bulls will likely remain in charge. But again, we believe at the 3-2 Warrior Academy that we are going to be entering into a recession over the next year, essentially, and it would be a good idea to diversify or have a plan to diversify out of some of your exposure, especially into the tech sector. Earnings season kicks off next week with the big banks, so we want to think about how that's going to impact this tech sector rotation as well. The upcoming earnings reports are going to be the ultimate test for this strategy. The flare-up in skepticism around the tech outlook will be front and center through the reporting period. Veteran strategist Ed Yardeni points out a major risk. Technology firms, especially the hyperscalers, might fail to beat analysts' overly optimistic estimates for the quarter. And in my opinion, that's because they're spending tons and tons of money on the AI. And the AI, while it's probably reducing expenses, it may not be reducing any kind of new revenue. And so their profits are going to maybe even decrease or fall flat from where they were during the last earnings period. Now, again, if these earnings miss, Yardeni warns it could trigger a severe correction among technology stocks. However, he notes that the broader stock market might completely dodge that correction if investors successfully rotate into lagging sectors that end up reporting better than expected earnings. And that's why one of my biggest positions right now for my actual retirement portfolio is focusing on consumer staple goods, which, while they're not going to be huge wide swings on the upside and or the downside, they're going to remain steady, especially if we end up going into a bear market or into a recession. Beyond earnings, we can't ignore the macro environment. Geopolitical developments are bank in focus. The Strait of Hormuz just saw the biggest day of attacks since the U.S.-Iran deal, which pushed U.S. oil prices up to $70. And this back and forth on oil is kind of ridiculous at this specific point. These strikes on ships have renewed worries about supply slowdowns that could keep energy costs elevated and fuel further inflation. In response, we saw Treasury 10-year yields rise to 4.5%, while higher oil prices lifted bond yields more broadly. Despite these macro headwinds, corporate wheeling and dealing hasn't slowed down. Amazon is looking to raise at least $25 billion through a US dollar bond sale, a jumbo debt offering designed to ramp up their spending on AI infrastructure. Over in the electric vehicle space, Rivian Automotive shares sank after announcing they will sell 75 million shares to fund equity contributions related to U.S. Department of Energy loans. In a historic piece of index news, SpaceX has officially joined the NASDAQ 100. Finally, looking globally, SK Hynix's massive $28 billion US listing is currently multiple times oversubscribed ahead of its pricing on Tuesday, and Reuters reports that China's DeepSeek is actively developing its own chip to power AI systems. So the AI race is not over, it's just becoming more developed, and when you see those types of things, some of that stuff kind of slows down as money kind of goes into it, kind of gets reshifted and diversified out of it. So you also need to make sure that you are doing that with your portfolio. And one of the best ways to learn how to do that and to understand that is to get good information. I like things like Barron's. I like things like Bloomberg's. I like the Wall Street Journal. I like the Economist. Read and learn as much as you can, and you too can become an investor. That's one of the main things that we try to focus on at the 3T Warrior Academy, is teaching people to take the sovereignty over their own life and the sovereignty over their own wealth and build the life that they specifically want. We'll be right back.
Hey, it's Ryan Reynolds here from Mint Mobile. Now, I was looking for fun ways to tell you that Mint's offer of unlimited premium wireless for $15 a month is back. So I thought it would be fun if we made $15 bills. But it turns out that's very illegal. So there goes my big idea for the commercial. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3 months, $90 for 6 months, or $180 for 12-month plan required. $15 per month equivalent. Taxes and fees extra. Initial plan term only. Greater than 50 gigabytes may slow when network is busy. See terms.
We just talked about the rotation of massive tech names, but there is a deeper evolution happening with the AI trend that we need to unpack. For years, the Magnificent Seven tech behemoths commanded total investor attention and practically dictated the direction of the S&P 500. These days, or those days, appear to be over. While the broader S&P 500 has climbed 10% in 2026, the Mag 7, I almost said the MSG 7, the Mag 7 index has completely stalled out, gaining a mere 1.7%. The correlation between big tech and the broader market has decoupled, dropping to its lowest point since 2017. So where is the AI money going? Investors are now aggressively pivoting away from the companies spending on AI infrastructure and shifting toward the biggest beneficiaries of the masses wave of cash, memory and storage chip makers. Companies like Micron Technology and SanDisk are surging to the top of the leaderboard. In stark contrast to the lagging Mag 7, the Philadelphia Stock Exchange Semiconductor Index is up an astonishing 73% in 2026, putting it on pace for its best year since 2003, which is fantastic. And if you didn't know there was a Philadelphia Stock Exchange, there is a Philadelphia Stock Exchange. So maybe go and research that. I would encourage you to understand that as well. Now, this sounds like a historic change of the guard. Our investors actually abandoning the biggest companies in the world just to buy memory chip makers. The capital flight is very real, and it all comes down to cash flow and skepticism. In June alone, investors pulled a record $786 million out of the Round Hill Magnificent 7 ETF, while simultaneously pouring a staggering $9.3 billion into the Round Hill Money ETF. The market is growing highly skeptical of the massive capital expenditures by companies like Microsoft, like Amazon, like Alphabet, like Meta. They are pouring billions into AI, which weighs heavily on their cash flows, but the payoffs aren't clear yet, which I mentioned in the last segment. Mark Zuckerberg even admitted recently that Meta's AI agent development has accelerated in the way that recently the Meta's AI development hasn't accelerated in the way that they expected. Because again, moving fast doesn't always mean moving better. Furthermore, Microsoft had its worst month since 2000 in June, dropping 20% due to aggressive AI spending concerns. And just so you know, I do have Microsoft in my portfolio, and I was part of that 20% drop. But I'm very long on Microsoft and on the leadership of Microsoft and Satya Nadella. Ultimately, investors are going where the returns are strongest. Earnings estimate for chipmakers have been revised dramatically, higher in the last 3 months, jumping to 48.5%. Meanwhile, earning expectations for the Mag 7 have actually shrunk. However, we should note that some strategists like Mike Wilson at Morgan Stanley and Nicholas Patagandozoglu of JP Morgan, I butchered that name, warned that the divergence isn't sustainable. They argue that once these massive cloud companies figure out how to better monetize their AI models, we could see a rapid rotation back into what we call the hyperscalers or back into the Mag 7. But for now, the memory chip makers are completely eclipsing them. And again, it goes back to what I was saying before, is that there's not a real great strong revenue model around AI, and the revenue model that is built around it has to do with partnerships with large companies using the AIs and charging them essentially for tokens because of their compute power. So again, when they're able to solve for that specific problem, we could see a lot of these large tech companies that have large AI models and that have a large piece of AI as part of their infrastructure make a lot of money utilizing it. It's just not 100% sure how, and I don't think a lot of people understand how they can implement it into their everyday lives apart from a more advanced search functionality. Before we move on, outside of the tech sector, you got to diversify your portfolio, and you have to spend time understanding on how to invest and what to invest in.
Have no fear, Chosen Foods is here to defend your favorite foods from the forces of seedy oils and sketchy ingredients. With cooking oils, salad dressings, and mayo, all powered by the good fats from 100% pure avocado oil and simple, delicious ingredients. Chosen Foods.
AI has been one of the main focal points of private equity markets, and now AI anxiety is creating a massive traffic jam. Private equity firms are sitting on a staggering backlog of roughly 13,500 unsold U.S. portfolio companies. At their current pace, analysts estimate it will take about 9 years for buyout firms to clear this log jam. The core issue dragging down these portfolios is software. After going on a major buying binge in 2020 and 2021, many private equity firms are now stuck holding software companies with rising debt loads and rapid worsening outlooks. The industry is calling this the SaaS-Pocalypse, essentially growing fears over how AI will disrupt the traditional software industry and have completely slashed the valuations of comparable tech companies. These private companies took out massive loans, assuming they would keep growing at their benchmark pandemic era pace, because no one has any insight into how businesses work in the long term for some reason, and private equity companies don't try to educate them on that. So now the private equity owners are extremely hesitant to sell them off at their significant lower valuations. If they can't sell these software companies at the valuations they want, and investors are getting impatient with holding periods extending to 6 or even 9 years, how are the private equity firms actually going to exit these investments? It's an incredibly tough spot. And Raymond James's Darius Creighton specifically noted that these 2021 assets are probably the hardest to exit right now because of where valuations currently sit. Because again, as I've mentioned before, everything has been overvaluated, and that is why we are in an AI bubble. To buy some time, firms are turning to the secondary market and setting up continuation vehicles, which allow fund investors to cash out while the firm keeps managing the assets. However, in real lifeline, here is the IPO market, which is finally coming back to life after being dormant for years. In the first half of the year alone, private equity firms managed to take 16 companies public, raising over $16 billion, the best 6-month period we've seen since late 2021, and they desperately need that window to stay open. Now, as Creighton from Raymond James points out, without a healthy IPO market, these alternative financial maneuvers feel a lot like they are just kicking the can down the road. Because again, if you can't take them IPO for an liquidity event or to raise capital, and the valuations are too low, you can't really sell them off. So you're just stuck with them. So if the IPO market comes back and they're able to offload these into the public markets essentially, then again, the private equity market could, I guess, get some of this backlog taken care of. So it's good to see the IPO market. But again, a lot of the private equity goes to where they think that money is going to be. And then those companies that are having those high valuations, they're not actually doing a great job running their company. And they think that the good times are always going to last. And the good times do not always last. For our final segment today, I'm going to shift our focus from Silicon Valley and private equity to geopolitics and global defense. So we're going around the world, as we always do, because world markets are just as important as US markets. As geopolitical tensions rise, governments worldwide have embarked on a once-in-a-generation arms buildup. However, the defense industry is hitting a massive wall. The companies making this military equipment are actively struggling to secure funding. To plug this massive gap, a group of allied countries just announced the creation of the Defense, Security, and Resilience Bank, or DSRB, at the NATO annual summit and at Ankara, Turkey. You can essentially think of this as a World Bank for military gear. For years, traditional multilateral banks have avoided defense financing largely because of ethical standards and public opposition, lumped with military industry into the same restricted categories as tobacco and pornography. While some commercial lenders like JP Morgan Chase and Citigroup are expanding their defense lending, many banks, investors, and insurance companies remain extremely hesitant. This capital squeeze is causing severe bottlenecks throughout the arms production supply chain, hitting the smaller component suppliers the hardest and impeding the manufacturing ramp up. If traditional banks and major lenders are hesitant because of ESG or ethical constraints, who is actually stepping up to fund the new defense banks? Are the US and Germany footing the bill? Interestingly, the founding members aren't the traditional military heavyweights like the US and Germany. The bank's biggest advocate is Canadian Prime Minister Mark Carney, who views this as an opportunity for middle powers to band together for geopolitical heft. Canada, Luxembourg, Turkey, Ukraine, and 5 other nations are launching the bank through deep-pocketed powers like the US, and Germany may join later. Here is how the mechanism actually works. These governments will leverage their sovereign credit ratings to capitalize the new bank, aiming to raise capital at a AAA rating. The DSRB will then use the capital to lend directly to national security projects or provide guarantees to commercial banks so they feel safe financing defense contractors. As Rob Murray, who originally conceived the DSRB, noted, finance is no longer just an economic issue, it's part of deterrence. These funds will support a massive range of projects, from building munition plants to boosting cybersecurity and even buying back critical infrastructure from risky investors in countries like China. The creation of this bank shows that capital allocation is increasingly becoming a matter of national security. And the reason why I'm bringing this up is because this is essentially creating a world bank that can be utilized to fund military projects for what we would traditionally call the Allies powers. And so if we think about this, this is a preparatory or a precedence or a preparation for the incoming military upgrades of North Korea, Russia, and China. So make sure that you're paying attention to what is happening right now, because I do believe that we're at the beginnings of what could eventually be a global conflict over the next 5 to 10 years. And with that, thank you so much for watching a Markets Radar. Make sure to check out our show next week. There won't be a show this Saturday because I will be out of town. If I can get some other content up, I will. And make sure that you check out the regular Age of Jeremy episode that launches on Wednesdays now until Markets Radar moves to its own feed. And with that, as I always say, be thankful, grateful, and kind. And we'll talk with you soon. Bye.